perspective, right? So if you know that there's a hole, if there's let's just say you're driving down the road and there's a boulder in the middle of the road, you know it's there, you can see it. Modern portfolio says, well, there's a boulder there. I'm going to hit the boulder, get thrown from the car, get all wrecked, and then, well, I'll just get back in the car and keep driving. You know what? It's funny when I hear these arguments about people say, well, is gold manipulated? Is silver manipulated? My answer is, what asset or market is not manipulated? Every single one of them is.
Everyone, this is Tim Picciott with the Liberty Advisor, and today I am joined by one of my colleagues, mentors, and one of the top wealth managers in the country, Kirk Chisholm. Kirk is the founder of Innovative Advisory Group, an RIA that's a registered investment advisory based out of Lexington, Massachusetts. Innovative specializes in self-directed IRAs, alternative investments, and they have a very unique approach on what other people might consider quote-unquote traditional investing. But before I begin, I do want to point out that I do work with Kirk. Kirk and I have known each other since about October of 2017. This is actually the first time I've actually ever seen him do a video interview. He's a prolific podcaster, always doing podcasts left and right. He's also the host of the Money Tree podcast, which you guys can find on iTunes and all the other places you can find podcast. But this is a rare occasion because we saw last week the markets got absolutely walloped. We'll probably do some more banter and some more explanations of how Kirk and I got to know each other and all that stuff at the end. But since this will be on YouTube and people usually want to catch to the point, we are coming off a week where the Dow was down 12.36%, the S&P was down 11.49%, NASDAQ down 10.44%, even gold was down 3.57%, down at 1566. Silver was down 10%. Bitcoin was down almost 12%. The 10-year treasury sitting in at 1.163. The 30-year is only at 1.684. Got 3-month bonds, treasuries sitting here in at 1.298. Oil prices down at 44.76. And I guess the VIX was up. So you got the VIX, the volatility index. It was up 23%, sitting above 40. And it's funny because I'm actually looking online. And it looks like there was one stock index that actually was up quite a bit. And that was the Zimbabwe stock market was up 67%. So I guess you could have been in Zimbabwe to fare well in this environment. But anyways, welcome to the show, Kirk. And the first thing people want to know is, do you get a lot of clients calling you? Are people worried about what's going on? And how did you guys fare this past week in the markets?
Yeah, thanks for that great introduction, Tim. This is glad to be on your show, and I'm excited to be here. Yeah, I mean, this past week, obviously, a lot of people were stressed out about the markets. I think they were unprepared. Certainly we got a number of calls from people, but usually they're calls from people who are not really aware of what's going on. They read something in the paper, they hear something on the news, and they freak out. But we were actually pretty well prepared for this. And, I think, these kind of markets happen. They happened about a year ago. They happened in December in Q4 of 2018. People were freaked out then. And then last year, people were up, or at least they thought they were up like 30%. And now it's down again and people are flipping out. I think this is, in my experience, this is kind of what happens at the tail end of a bull market. Volatility tends to pick up, tends to be more volatile. You'll see more of these corrections. And, it doesn't mean the market won't keep going up. It just means that the volatility is definitely going to pick up.
Yeah. And so, one thing that we were doing very well, because I did mention to the viewers that we do work together. And if there was, one person, I guess there would be two people that'd be my quote unquote bosses, and you would be one of them, which is, usually probably not a very good spot to be, being one of my bosses. But anyways, with Kirk is one of the guys who I probably talk to more on a daily basis than just about anybody. I mean, we've got, John Snyson and Josh Segerson I talk with quite a bit, but Kirk is really, I guess, would be the, not to call him like the puppet master behind the scenes, but he's, a lot of my investment strategies and things that we do over here. I mean, Kirk does manage money for some of my clients. Some clients we collaborate on, some, I'm managing. So there's a collaboration. And really, when it comes to other financial advisors that I respect and I follow, I mean, there's very, very few of them. But what I really liked with what Kirk was doing, because I was trying to develop this situation, but over at my previous firm, using options and trying to do what's called a covered call. But my previous firm wouldn't allow me to actually do this because I thought options were big, bad, scary, and dangerous. And obviously you've got to, kind of have your compliance all the way down to the lowest common denominator. So one of the reasons I wanted to come over with and do and be with Innovative is I saw what they were doing from a risk management standpoint. And, I got into the market September 15th, 2008, when Lehman Brothers was collapsing, like the day Lehman Brothers started collapsing. Kirk got into the market in 1990, I believe it was 98 or 99. And can you just give us some, lessons that maybe you guys learned from, what happened during in 2008, and maybe how you guys are managing money today, that's as a result of what you saw going on back in your experience for both the dot-com bubble and 2008?
Yeah, thanks a lot, Tim. I appreciate the high accolades, especially coming from you. So I appreciate that. Yeah, I'll tell you a little bit about my
Most of the time I'm
backstory
tearing people
and
down and not giving them accolades, so that does mean something. So.
Yeah, no, it's interesting. So I've been just a little bit of my backstory. So I've been doing this for about 20 years. I actually got in the industry in December of '99. So if you can really think of a worse time to get in, let me know, because that was pretty rough. People went through decades of a bull market, and everyone thought it was easy to make money. And I came in December, and I didn't have all of that. I didn't have all of that experience where things only go up. And so when I started, I had to learn risk management really quickly, because pretty much in the end of Q1 of 2000, the market started to go down, and they went down for a few years. So I had to learn really quickly what risk management was all about. And I'm very fortunate that I got through that tough period, because it really helped instill this risk management first strategy. And, a lot of people look at this market and they say, oh, how can we make money? We're going to beat the index. We're going to outperform. We're going to get 30% returns a year. They're bragging about their upside. But what I think that is interesting is that that's a real sexy story that people try to sell. But if you really understand numbers, you don't need to outperform the index every year. All you really need to do is not lose a ton of money when the markets crash. And if you do that, you're going to outperform the index over time. So what happened we learned that lesson, and then, 2003 came, and the Iraq War started, and then the markets picked up until 2008. And in August of 2007, we decided, I have a lot of connections, and we do a lot of research on the markets, and we decided that the markets were really, let's just say we were uncomfortable with the risks that were going on in the real estate market. So we went all to cash. And that was kind of a bold move at the time, and it kind of scared the pants off me, because the market could have kept going up for 30%, 40% more, and then you kind of look stupid. So, but at the time, we thought it was worth the risk, because we saw the writing on the wall. We didn't know how bad it was going to get, but we certainly knew it was going to be bad. So we're fortunate to have gotten out at that point. And we waited until early 2009 before we got back in. But at that point in time, things were really scary, right? I mean, you can all probably remember what it was like back then, where the banks you didn't know which banks were solvent. You thought they were, but you didn't really know, because even if you were really aggressive and went all in March of 2009, like, that was still a scary period. Like, you kind of hoped that things were going to be okay, but you didn't really know.
I mean, the
So
Time
we
magazine
started to
cover was like an actual, was it like the thread, it was a rope that was just holding on by a thread, and somebody holding on which is always the best contrarian indicator that that's the best time to start investing. Just as a FYI, not financial advice, but no, that's usually what the best time to do it. Everyone's freaking out.
Yeah, it usually is. Yeah, when you see the cover of a magazine, it's like the bull market and X is here. That's the time to get out. So if you look back then, we started to dip our toes in, but we realized that, all right, we've managed risk really well through two bear markets. The first one I did the normal way, which is what most people do. You just you diversify and you reduce that risk, and we outperformed the indexes those years. But at the same point, it was still a rough period. So I didn't like the fact that it's okay to lose money, because to me that's not acceptable. So what we did in the next one in 2008, we went all to cash, which worked better, but at the same point, there's some things that I didn't like about it. So this time we've gotten a lot more technical, highly technical with our approach, and I think this approach has been a lot better at managing risk. So this market, right now where we are, I mean, the market sold off would just say it was about 12% or so on the S&P. That's not a lot. I mean, people are freaking out, but the market was down
That's like
20%
20
in
minutes. That's like 20
Q4.
minutes in Bitcoin.
Yeah, yeah, that's like one blip. That's one tick of Bitcoin.
Gone.
Yeah, but if you look at Q4 of 2008 of 18, it was down 20% from peak to trough, right? So we don't know how low this is going to go at this point. I mean, we're talking it's only 1 week, but at the same point, the market could bounce back and go up 50% from here. So the way we look at it is, how can we have our cake and eat it too? How can we make money when the market's going up, and how can we not lose money when it's going down? And that's how we approach things. So our strategy really is finely tuned for this type of market. It's the tail end of a bull market, which you tend to have some of the highest returns. I mean, last year, although the numbers are deceiving, last year looked like one of those stellar years. 30 some odd percent. It wasn't really, but if you look at it point to point, it was. So if you look at that kind of a market,
companies weren't really like the companies themselves weren't really earning more money, and I mean, it was basically just people paying more money for the exact same stocks, and so it's very weird to see the market just going up to the roof, but yet the company's information was almost flat. And so I mean, yeah, people are just paying more money, and then that optimism creates this whole self-fulfilling prophecy. And you've got the president saying it's the greatest economy ever, which then builds more of this this builds momentum towards that. I'm sorry for cutting you off on that point.
No worries. But if you kind of look at the markets, we're in this kind of market where it could go up another 30 or 50% from here. I'm not saying it's a rational approach, but it certainly could happen. It's probable that could happen. And the markets could also go down 30 or 50% from here. You just don't know. And so if anybody tells you what's going to happen in the future, they're pulling your leg, because no one knows the future.
They're trying to
what we look at,
more than likely.
Exactly. Yeah, I mean, they're probably trying to sell something. They're trying to sell themselves as an expert. And the reality is, you can't look at it from that kind of a perspective. You have to look at it as a probabilistic perspective. What are the probabilities this is going to happen? What are the probabilities this is going to happen? So I think it's very equal probabilistic that it could go up and down. I'm not trying to predict the future. All I'm doing is I'm just managing the potential outcomes. So if you look at a market, any market, if you're investing, you have to look at what's your strategy. So most people, I'd say 80% plus of the people out there, are using a buy and hold modern portfolio theory. Let's diversify between multiple different investments, and that'll reduce your risk. That's what most people do. Institutions do that as well. I don't find that to be particularly effective in this kind of market. The reason being is that type of approach, you have to accept the fact that you can also lose a boatload of money, because that's part of the bargain you're making. Buy and hold is a buy and hold through thick and thin, up and down markets. You just have to hold and weigh it out. Well, that's fine if you're 20. But if you're 65 and you're retiring next year, you can't afford to take that risk of losing half your stuff. So I don't think that's an appropriate strategy for this kind of market. I think there are times where that is an appropriate approach. I just don't think this is one of them. So in this type of market, you have to look at every single strategy. What is the potential outcomes? What are the pros and cons of using those strategies? So in MPT, the positive approach is you're taking advantage of the fact the market goes up 70% of the time.
That's a modern
you're taking advantage
theory for the people that might not know that. Yep.
Correct. Right. That's your typical, I'll buy you 10 mutual funds and diversify you, and that'll be your portfolio. So institutions use that. There's nothing wrong with that approach. It's just, in this type of market, it's not the best approach, because you have to assume the fact that you're also potentially going to lose in the future, because you can't know the future. So you have to accept that going in. So let's look at the different portfolios. I think that's probably more advantageous for your listeners and viewers to go through this. So MPT, right? Let's say you buy 10 different mutual funds, large cap, mid cap, small cap, U.S., international, bonds. You diversify between different assets, and supposedly that's going to reduce your risk. That's the claim, right? Well, in normal markets, it actually does that. The problem is when the markets sell off in times like specifically December of 2018. I think it was 2015, I believe, in December, when with the oil crisis, the market started to really have a little contagion effect there. 2008. There are a few times where this has happened, and the problem is that type of methodology no longer works. So correlation works well in normal times, but when things get really hairy and they get, like those times I just mentioned, correlations stop functioning normally. So what happens is MPT no longer works. Everything goes down the same amount. 2008 is a perfect example. Almost everything you owned was down 38.5%, regardless of what it was. That shouldn't happen.
And the one
right?
thing is, though, you
But
could
it
actually
did.
you could actually camp out in bonds in 2008, or let's say it was 2006. You could camp out in some relatively safe bonds and probably get 6, 7, 8%. Well, nowadays, I mean, we just read this off now. I mean, the 30-year Treasury is coming in at 1.684, and so I mean, if the real inflation rate's really 4 or 5 or 6%, and you're only getting paid, let's even round it up to 2, you're still really losing 4% of your purchasing power and going broke safely. And I'm sure later on you've got some other comments about the inflation rates, but yeah, but this time it's different because you can't even camp out in bonds this time because you're going to get wrecked and you're going to get paid, next to nothing. And so unless you're just living way below your means and just have a huge stash of money to live off of, it's going to be very tough for most Americans when I think there's 61% of Americans 55 to 65 have less than $100,000 saved for their 401ks in retirement.
Yeah, inflation is a problem. We'll get to that later because that's a lesser problem in these kind of times. Because during these times, my big concern is not losing half my stuff, right? So if you think about MPT, for example, let's say you diversify. Let's say you're not 100% in equities, right? So if you're 100% in equities, they go down by half. You're going to lose half your stuff, right? So that's a bad scenario. But let's say you're, I don't know, like 50% in bonds, for example. And let's say bonds are break even because we don't know where bonds are going to go. Sometimes bonds will go up, sometimes they go down, depending on the quality. But let's just say they're neutral. So instead of losing 50%, now you're only losing 25%. Well, that's still 25% of your stuff. Who wants to do that, right? That's in some cases that's permanent impairment of capital. That's a permanent loss, right? Because if it takes you 10 years to make it back, then you lost 10 years of your life that you can be compounding your growth. So I look at that as a permanent impairment of capital. So if you kind of take a step back and look at it and say, is this the best approach for this environment? Well, in this environment, I'd say no. There are environments, a lot of environments where that actually works well. This is just not one of them. So if you look at this environment, well, let's take it from this perspective. The market has three outcomes. It goes up, it goes down, or it goes sideways, right? So modern portfolio theory approach does really well in the up environments, does reasonably well in the neutral environments, and the down environments, maybe it does okay, maybe it doesn't. It depends on the market environment. But effectively, you're accepting the fact that you're going to lose money in a negative environment. I don't accept that. I don't take that at face value and just say that's okay, because it's not okay, because you can do something about that. So if you look at it from a different perspective, like what we did, the way I look at portfolios is very different than most. I'm looking at it from an agility perspective, right? So if you know that there's a hole, if there's let's just say you're driving down the road and there's a boulder in the middle of the road, it's there, you can see it. Modern portfolio says, well, there's a boulder there. I'm going to hit the boulder, get thrown from the car, get all wrecked, and then, well, I'll just get back in the car and keep driving. That just seems like nonsense to me. My approach is, why don't you just drive around the boulder, right? I mean, you see it there. Why not just drive around it? So we have a more
Government's
tactical
approach is they should just make put boulders and roads illegal, and then that would just solve it all. So or make a tax on it.
Yeah. Yes, you could just go straight up forever, and you don't have anything to worry about. Yeah, that actually is kind of the environment that we're living in now, anyway. Because the market goes down too much, the Fed steps in, and then they raise the markets again, and they're doing this all around the world. So it's funny when I hear these arguments about people say, "Well, is gold manipulated? Is silver manipulated?" My answer is, what asset or market is not manipulated? Every single one of them is. All these central banks, these governments are in there buying these assets to prop up asset prices. And they're telling us they're doing it. It's not a secret. It's not like this conspiracy. They're telling us outright that we are doing this. So it's not a question of whether they're manipulating it. They are. The question is when does the train stop? When does
And
the
they're
music
even
stop?
they're
You
even
know,
saying that they're going to keep doing it in the future, and that during the next downturn, I think Paul just said this like not even a month ago at the Senate Finance Banking Committee that the plan is to have aggressive quantitative easing, which right now what they're doing in the repo market, which is a whole other can of worms, but they're calling that not aggressive. So like $100 billion, printing 10% of the country's entire monetary supply since September. Apparently that doesn't count as aggressive, but they're gonna be aggressive at some point in the future. But continue.
yeah, no, and yeah, actually, you had a great speech about the repo market when you were in Anarchapulco, so I highly suggest the viewers watch that because it was a great presentation. But if you're looking at the markets in general, like I said, I don't know the future. No one does, and I know that I don't know the future. So the question you're probably asking is, well, if MPT doesn't work in this market, what does? So we actually spent a few years developing this strategy, and what it comes down to is this. If you look at those three outcomes, right, up, down, or sideways, you have to accept that at least one of those is going to go against your favor, right? So which one is the best one to go against your favor? Well, you don't want to lose up on the upside because then you're not making any money. You don't want to lose out on the downside because then you're going to be losing money. If I'm going to lose out, I would rather lose out on this sideways market. Sideways markets are much more infrequent. They do happen, but they're much more infrequent. And if you look at how they operate, if you're going to lose a few percentage points in the sideways market, I'd much rather have that than losing half my stuff in a sell-off. So if you actually look through it's a lot of this is math, right? It's just you look through the statistics, you figure out like, all right, here's what markets typically do. Our strategy takes advantage of the upside when the market goes up. So we're making money when the market goes up. When the market sells off, we're not losing money. But in the sideways markets, we have a little bit of a drag in the portfolio. So that's really where we underperform a little bit. But for me, I look at that as a very reasonable exchange for not losing half my stuff. So the strategy itself really, in many ways, it operates kind of like we don't use insurance. I want to be very clear. This is not about insurance, but it operates the best way I can describe it. It's like, let's say you own your home, right? Let's say you own your house. You own it. Let's say it's cost you $100,000, right? You pay $100,000 for your house. Great, right? So the house, let's say 5 years later, the house goes up in value. Now it's worth 120,000, right? Okay, so your house is worth 120,000. Then the next day your house burns down. Now your house is worth zero. Well, that's a huge loss. Why would you want to take the risk that your house is going to burn down? So you buy fire insurance, right? Doesn't cost you very much. I don't know what it costs, but maybe 0.5% a year or something. But it's really cheap. So you buy fire insurance. So if your house does burn down, you get your money back, and then you can go rebuild your house again and go on. And what you lose is effectively your premium. So you pay for premium for the insurance. Well, you're going to lose that, but what you're doing is you're insuring against your house burning down. So your portfolio, the way we operate, is very similar. So basically, you're insuring your portfolio against loss. So if the market does melt down, then you get your money back, and you don't have to worry about these huge losses that come into play when the market sells off, or at some point. And if you've only been in the market for 10 years or less, then actually it was 11 years or less now, then you've really missed out on what a bear market or recession looks like. If you haven't been through one, it's scary as heck. And I can tell you firsthand that if you don't know how they operate, then you need to be very cautious, because if you're using a bull market mindset in a bear market, you're going to lose lots of money. Bear markets have their own type of feel, they have their own energy, their own momentum. And effectively, what a bear market is it. The way it operates is it costs the most amount of people to lose the most amount of money. That's how they operate. They're not rational like they do in a bull market. They're just you have to completely reset how you think about markets during a recession. So we align our strategy, which is working out extremely well right now, and it will continue to work out well until we have a recession. At that point, then we switch strategies into another strategy that we have that works really well during recessions. But right now, this is the best approach because it's all about protecting against loss. Because if you can protect against loss, think about the math this way, right? Let's say you have $100. Then the market sells off 50%. Now you've got $50, right? Well, let's say you weren't in the market and you were in cash. The market still went down 50%. Now you can buy twice as much stuff because you still have your $100 and things are worth half as much, which means you can buy twice as much stuff, which effectively means you just doubled your money. And I know it's a weird way to look at it, but if you're looking at the value of things, the value of buying something, and it's 50% off, you can buy twice as much. You just doubled your money. So that's how we look at it. And so during the next recession, that's the time where you go bargain hunting, and that's where you make really good money if you pick well and you buy the right stocks.
Yeah, because over the past month, there's been very, very few stocks that have been positive. I was looking at a market monitor earlier today, and it was very, very few. It's such a very tiny percentage, and so we try taking a look at the bigger tectonic movements that are going to go on, and not necessarily looking down into the micro as a lot of people would do. And you did mention too, this strategy could underperform in certain market environments, but I want to also highlight underperforming compared to what. And so we're talking about underperforming compared to the S&P 500 generally, which has been one of the hottest asset classes. Obviously notwithstanding Bitcoin and crypto, but one of the hottest traditional asset classes you could have been in the past 11 years has been the S&P 500. And realistically, most people who are coming to us who are 60 years old, 55 years old, 65 years old are not 100% in the S&P. So if they were half bonds, half stocks, or 60% stocks, 40% bonds, we still way the hell outperform that for that type of portfolio. It's just that if you were to compare us directly to if someone that was just letting it all ride in the S&P 500, then on the ups we're going to lag that a little bit. On the downs, we're going to be nowhere near the amount of risk in this type of strategy. But in the sideways market, relative to the S&P, the strategy would, there is some downside. So I don't want to be like a snake oil salesman up here being like, this strategy works no matter what all the time, because there are situations where it wouldn't necessarily work, because unfortunately we do have to compete against people who can say whatever the hell they want to say in these types of forums, and who can just really use a lot of puffery to make themselves sound a lot better than what they really are. But I did want to point out though that we're only comparing this underperformance relative to someone who had 100% S&P, and if you're 55, you should not have 100% of your money in the S&P, at least in my opinion, because the big thing we're really trying to mitigate against is actually something called sequence of return risk. And actually, I was able to pull this up while Kirk was breaking things down for us. And what this shows is if somebody had, let me see if I can pull. No, this is probably okay. So if someone were to lose 20% and they're actively withdrawing 4%, they have to gain 42% over the next 3 years to get back to even. Now, if you lose half your money and you're actively withdrawing 4% to live off of, you then need to go up 132% to get back to even. But what happens then is that somebody's already freaked out. They've already, they're already calling their broker, their advisor. They're already selling. They've already missed, a lot. They're going to miss a lot of the upside. I see people now who just trying to get into market after Trump won, and which I guess in hindsight would have been, a decent thing to do. But, okay, you miss out on the first, 8 years of a bull market, and now you guys want to jump in, or now, 11 or 12 years. The next slide here shows two investors. They both start off with the exact same amount of money. And let me kind of, I know I'm gonna have to blow this one up. My eyes are not good. I'm getting old here. So it shows someone that's got $1 million. They averaged 5.1% return, half in stocks, half in bonds. They're pulling $50,000 out per year. They earn the exact same thing, but investor A started off with 3 bad years. Investor B ended with 3 bad years, and essentially investor A has $400,000 less than investor B. And it all has to do with when they retire. And this will be the last thing I say before I go back to Kirk, a slide that I've gone over a lot of times in the past, because if you are close to retirement, it doesn't matter what your average return is. It matters more importantly what the order of your returns are. So if you went to retire a week and a half ago and boom, all of a sudden your portfolio is down 15%, then you're going to be in some trouble. So what I'm looking at now, this is from the Prudential, the 2015 LIMRA fact book. It has someone that started off with $500,000. They're withdrawing 4.05% annually, basically a 60-40 portfolio. That's 42.5% in the Dow Jones, 17.5% in the Russell. Of course, is right where my camera is. So I'm trying to read what it says down here. And then 40% in an intermediate bond fund that's rebalanced annually. And what this shows is the person that retired in April of 1970 after 30 years had about $2.6 million left. The person that retired 16 months earlier, January of 1969, ran out of money at age 91, and then it has all the data in between. So somebody that retired in April of 1969 would have had about 600,000. And so these are real world results of how things have actually played out. But sequence of return risk can also go in the opposite way as well. So Kirk mentioned earlier that these markets, there's a good chance that they could go up another 30, 50%. And maybe it's not rational to do that. Maybe it's more rational that it could go down 50, but we are hedged essentially in both ways, because I think that, we looked at what happened in December of 2018. Okay, the market went down basically 20% on the nose, and that's when all the cavalry came out. You had Mnuchin and the whole plunge protection team, and the Federal Reserve stopped all of their rate hikes. They mentioned they're going to stop their quantitative tightening program, which is $50 billion a month, which I knew they couldn't do. And so you saw all this massive action by central banks. And I expected at some point that when the market goes down a certain percentage, that you're going to see the central banks pop in. But the good news is with our strategy, we're really right. Our strategy works if there's a big crash, and it works if the market keeps going up a lot too. So it's just those flat markets. And I think in this crazy type of environment, you'd have to be insane not to at least look at something like Kirk and I are doing. So I wanted to, I don't know if you had any commentary on when I was talking about the underperformance and some of the negative pitfalls to our strategy, because it's not something we're going to be in all the time. This is not just a set it and forget it. There is a tactical approach to what we're doing, even though it seems like it could be simple.
Yeah, no, your point's valid. So if you think about it from the perspective of any sort of investing, you need to understand yourself, right? So you need to understand what your personal strengths and weaknesses are. So I know I have some personal weaknesses when it comes to investing, and I have some strengths, and I know what those are so that I invest with a strategy that makes sense around that. So my strategy is very specific in some ways to counterbalance some of my weaknesses. Everybody has them. Warren Buffett has them. Every smart investor has them. But what's more important is understanding what those are. So just like with investing, you also need to be agile with your mindset. So what'll happen a lot is you hear about these really famous investors, and they have one way of doing things. And no matter what happens, they're going to stick with it, rain or shine, they're going to do the same thing over and over, and that's fine. If they're running a fund, that's probably what they should be doing. We're a wealth management firm. We're about managing wealth. We're not about doing the same strategy over and over and over again. So what we do is, we're always taking a very tactical perspective. All right, from this market, what is the most appropriate approach to take? So in 2009, we had a very different approach. It was almost actually the opposite approach of what we're doing now. But it's a very different approach because we're looking at it so our strategy is really about risk management first. So how do we manage risk? How do we, and more accurately, it's about defining risk. So if you look at risk management, what it comes down to is understanding what all the risks are, mitigating as many as possible, and being comfortable with what's left over. So if you have an MPT portfolio and you're comfortable losing half your stuff, then it's probably fine for you. It's not acceptable to me, but I'm not you. So, what we do is, we manage money for other people. So our strategy is about, protecting wealth and growing it over time. If you want to take high risks and assume that's going to give you high returns, that's up to you. Those actually, that is kind of a myth in itself, is, taking high risk doesn't necessarily equate to high returns. But what's more important is being tactical with your approach, understanding the markets, understanding the best approach per each market, and understanding how to manage the risk. So when we look at risk management first, our approach is, how do we not lose money? And if we're comfortable with all of what's left over, then we're okay. So the way I look at it, as I described earlier, sideways markets are probably our weak spot, but we're aware of that. And actually we try to minimize that weakness as much as possible, but it's going to be there. It's just part of how our strategy works. But we're comfortable with that, and we accept the fact that that is what it is. But we're more comfortable with the fact that we've defined our risk. So we know that there's a point in time that no matter what the market does, we're not going to lose any more money. And that's how we defined it. So we can tell you to the penny, like, you're not going to lose more than X when we set it out. And that number varies based on the market, but effectively we can define that. So that's really important. So if you're comfortable with, if you say, well, I don't want to lose more than 10% or 5% or 2% or whatever it is, we can define that number and we could say, all right, here's what that looks like. So what it really is our strategy is about, it's probability and math based, which I think is probably the more appropriate approach to take. But it's also about not knowing the outcome and just saying, all right, based on what is the worst thing that could happen here? Because at some point that is going to happen. I think we can all try to deny it, but it happened in 2008, happened in early 2000, about every 10 years or so it happens. So we're overdue for that happening, and it will happen at some point. And we're prepared for that. And then
Now, what do you have to say
as
to
soon
the
as that
people
happens, we'll move on.
There's probably people out there who are probably thinking, okay, I know what this guy is doing. He's probably just putting in stop losses at 10%, and that's how he's managing the risk. And so can you kind of compare our strategy to a stop loss? Because I think one thing, at least with the stop loss, is you see different flash crash situations where all of a sudden everyone tries to rush for the door at the exact same time, and then then you end up selling your stock for a penny when it's really worth $100, which you have seen things like that happen in the past.
Yeah, and actually, I'm glad you brought that up, Tim, because we used to use stop losses in our portfolio, and I think it was 2010 or 2011 where that really didn't work very well. And one of those years, I think it might have been 2011, where the market went up or down over 10%. I think it was like 20 times in one year. I mean, huge volatility swings in one year. And if you were using stop losses, you got stopped out so many times. And I knew a lot of people who were using stop losses, and they were complaining about it. They said, "Oh, I'm doing terrible this year because I'm getting stopped out," and then the market goes right back. And if you're really methodical about your approach, then that's what you should do. And those years won't happen often, but they can happen. And the way I look at it is stop losses can work for some people, but that's actually one of my weaker areas, because I know that if it goes down, let's say 10%, and that's my stop loss, I know that I can look at it and say, well, actually, if it goes down 11%, it might bounce from here. But then you get stuck in this, is it going to go down more? This seems like the bottom, and you're trying to predict the future. So your kind of animal brain takes over, your lizard brain takes over, and decides to operate the ship, and that's when you make bad decisions. So it's really important to understand what your strengths and weaknesses are. Some people can operate really well in that environment. I don't. So our strategy is a little bit different in that it compensates for that, and we basically hedge the portfolio, in very safe ways, so that it allows us to define the risk, so that and Tim, actually, you brought up a good point about, let's just say let's say tomorrow and the market opens up, down like 500,000, 3,000 points, whatever it is. Say there was like a 1987 crash kind of a thing, right? That can happen overnight. That could happen right now, right? Some big event could happen over the weekend, and then the Monday it's going to open up huge on the downside. There's nothing you can do about that, because a stop loss is not going to protect you from that, because it happens when the market's not open. And actually, even if it does open, it can blow through your stop loss, and then you're really in trouble, because what will happen is, let's say your stop loss is like 2%, right? So it goes down 2%, and then you're stopped out. But what if the market immediately goes down 10% because there's some event in another country, and it just instantly goes down? So this actually happened a few years ago with the VIX. The VIX was like at 14, and then it went to 50 almost overnight. And I know a lot of people lost all their money, because they were just shorting the VIX, and the VIX went through the roof, and they weren't expecting it, and they lost everything. I know people that weren't clients, but
I had a video where I was on Ernie's show, so Ernest Hancock's show, and he asked me 2 weeks before that happened, he just happened to ask, "What's the worst investment you could possibly make right now?" And I actually said on the radio, I go, "The worst thing you could probably do right now is to bet against the VIX." And 2 weeks later, what do they call it? The VIXopolis, or and actually, one of my clients had some of her money with me, some of her money with another advisor. Luckily, most of it was with me. And that other advisor's account went to zero, an actual goose egg, because he was in this conservative, I don't even know what it's called, but it was in some sort of conservative growth fund, even though they were just betting against the
Yeah.
VIX, which I thought was and this was like, the VIX is like 9 or 10. I mean, the saying is, picking up pennies in front of steamrollers. And so, I mean, today it's at 40. And so luckily with the VIX at 40, we probably don't have to worry about about having a flat market type strategy right now, or sideways market, because a VIX at 40, I mean, it probably doesn't get to 40 very often.
Right. And that's a great point, because when that happened, like I had a few people call me and they're like, "Hey, I just lost, I want to sue, Fidelity or TD or whatever," and they wanted to sue the custodian because somehow felt they were responsible. But even the ETF or the mutual fund, they had it in their language and their prospectus. It says you could lose all your money in this strategy. It said that. It was actually not even a secret. People in Wall Street were like sending around emails back and forth to each other and say, "Hey, check this out. This is funny." So it wasn't a secret that this was going to potentially happen. Like, a lot of people were aware of it. We were actually on the other side of that, and during that period, because we knew that it was really cheap, and you could take the other side of that trade, because it was kind of a no-brainer on the other side. But my point is that if you're looking at markets and you think things are too easy, it usually means that it's time for things to kind of go the other way. So it's really important to understand the risks. And at that time, that was a risk that I understood extremely well, because it was, like I said, we were on the other side of that strategy. So we made out well during that. But a lot of people didn't. And what's scary is, there were a lot of people who were looking for conservative funds. This one fund that you mentioned was marketed as a conservative fund. It was far from conservative, but they were marketing that way, and people lost, and there's lawsuits, and there's all stuff going on. But the point being is you just have to understand what you're in. And I think what a lot of people don't understand is they don't understand what they're investing in. So if you're buying in a buy and hold, you probably understand what you're in. But if you have these convoluted strategies that you don't understand, then you ought to be cautious, or better yet, use an advisor who does understand this stuff, so that you don't have to. Tim and I do this for a living, but if you're a doctor or a dentist or an attorney or whoever you are, and you have a full-time job, you don't have time to keep up on all this stuff. I mean, we barely do. The market is a fast-moving place that there's so much information, it's hard to keep track of it all. So it's important to keep your strategy to something or work with somebody who does really understand it.
I mean, and how many advisors can be out? I mean, when all this stuff was going down last week, I mean, I was out there making podcasts, calling clients, being proactively, but I was calling them with a smile on my face. And like, you know what, some of the positions that we bought a month ago, a half ago, are up almost 200%, which then helped counteract what was going on the other side of the portfolio. And so again, you don't want to run this all the time. There are risks to doing so. I probably only got about another 15 minutes before I got to go head off and do some family stuff right now. We'll have Kirk back again, because he's such a wealth of knowledge on so many different subjects, and especially different market analysis. Maybe if we do open up down 3,000 or something, we'll do an emergency podcast. But yeah, there's a lot of different areas that we can get into. But I think I want to share, just first how Kirk and I met. So I was at this conference called FinCon, which was a sort of like a financial media conference, blogger conference. I knew nothing really about that world, other than I created sort of like a financial page on Facebook that also kind of bled into politics, and I exploded it. And I figured I better find a way to, see what the real pros are doing. Well, I met a guy who, I was telling him what I was up to. I was trying to do crypto IRAs. This is, mind you, this was October 2017, before the big Bitcoin run up, right before, like a week and a half before it. And I meet this guy. I think his name was Sean. You might know his name. What was the guy's name, or what podcast does he represent?
Oh, he's going to kill me not remembering his last name, but yeah, Sean.
Two Frugal Dudes or something like that.
Two Frugal Dudes. Yeah, that's his podcast. Yep.
Okay. And I've never even listened to it or been on it. So I can't, guys, because we didn't really prep any of this before we came on. And so with the Two Frugal Dudes, so he came up to me, and I told him what I was up to, and he goes, "You know what? You need to meet Kirk Chisholm." He's like, "I just interviewed him. like a week and a half ago. And I'm like, well, why do I need to meet him? He's like, well, he has a registered investment advisory, an RIA, that specializes in self-directed IRAs. I'm like, wait, that even exists? I'm like, I pretty much up on everything. I'm like, wait, that's even like a category. Like, I didn't even know people even did that. And he goes, actually, he's like, I think he's here at this conference. And so I'm like, all right, if we can get a hold of him, great. If not, I'm busy doing stuff. And I think I got sick that weekend too. And so the main guy who I wanted to meet that weekend was this guy named Jeff Rose. So he's sort of like the big superstar in the FinCon community, probably the biggest superstar there, or at least one of them. And so I'd followed some of his work, saw what he was doing, and really wanted to be able to pick his brain. So I finally had the opportunity where I was about 3 feet away from Jeff Rose, and meanwhile my voice was kind of already shot at this point. And then all of a sudden Sean taps me on the shoulder, and he's like, hey, that Kirk guy that I was telling you about, he's like, he's right over there, like 15 feet to your left. And I'm thinking, oh shit, I really want to talk to Jeff. He's like the main superstar. I'm like, but I don't know if I could talk with Kirk again. So actually I left the conversation that I didn't even have yet with Jeff to go talk with Kirk. And actually, to this day, I still have never actually talked with Jeff. So it's been like 3 years now. So maybe you can hook me up at some point, or we can send him this.
I'll do that next year.
Yeah.
Jeff's a good egg. Yeah, and actually, it's just to give him credit. His name's Sean Marin and Kevin Griffin at Two Frugal Dudes. I got to give them credit because I love Sean. He's a great connector, and he's a good egg. So he runs a good podcast.
Yeah. So I was in no hurry or did not want to move anywhere. There was 0% chance I wanted to do anything. And so I'm like, I'll go meet Kirk, pick his brain. And so he, immediately was like, okay, he's looking at some young kid. He's like, okay, so you want to do crypto IRAs? And he's kind of smiling, and he's peppers off like 25, 30, 40 questions to me. And I knew the answer to most of them. And then he went from like, okay, well, now we need to figure out a way to work together because you actually do know quite a bit about this sort of stuff. And then I end up going to Jeff Rose's seminar and somebody's asking him, how do you get away with everything you get away with, compliance wise? And I'm not even lying. He goes, well, as long as you're not doing something stupid like talking about Bitcoin, he's like, you're going to be okay. And I'm like, shit, that's exactly what I was planning on doing. I'm sitting in the back. And then a week and a half later, like Bitcoin goes through the roof. And then I see him on like Forbes and Inc. magazine as like their Bitcoin expert. I'm like, are you kidding me? You just said the one thing you don't do is talk about Bitcoin. And then here he is now as a Bitcoin expert after. And so it's funny how this all comes around full circle. And I'm sure a lot of you guys already know the story where things went next, but I ended up leaving LPL because they wouldn't let me do the things that I wanted to do from an advisory standpoint. And so now I am teamed up with Kirk. And so I just wanted to get that whole backstory of how we ended up meeting up. But speaking of alternative investments and some of the other, more outlandish things that we can do, I mean, maybe do you want to get into, I know we've got like a Mitt Romney self-directed IRA story, or maybe get into, some of the more exotic things that, people can do inside their IRA, and maybe even tease them with, I'm not sure if you've got any, I know you've got like a big list of investments that people can go to your website to go get. So I'm not sure if you want to plug that in any show notes that I can include that. But yeah, just want to give the people. I mean, obviously we already went through like all the ways we're different with all the hedging strategies they're using. But on top of that, it was like, but wait, there's more. And so part of this more is we have clients that have crypto inside of their IRA where they have the private keys. Clients who have gold inside their IRAs. There's lots of different ways they can have gold. But what are some of the as an alternative investment expert, I mean, what are some of the things that you've got people doing, or what are the things that we as a firm are able to do that other firms just aren't able to offer?
Yeah, so I, if you haven't guessed it already, we're very much outside the box thinkers, or I should just say thinkers, because that's, I think, one of the things that we really kind of look at this firm, which is why I like Tim, because I know he's a thinker as well. So the way I would kind of describe us is Wall Street. Wall Street's a funny place. It operates like this. Out of 10 people, one person is doing the research. The second person knows the person who's doing the research. The third person knows the person who knows the person who did the research. The fourth person knows the person knows the person knows the person who did the research. Everybody else hears about this at a cocktail party.
It's like a credit.
That's how Wall Street works.
It's like a credit default swap of research. So.
Pretty much, yeah. So there's really one person doing the research, and everybody else is hearing about it, and then they go and invest based on that secondhand or third-hand or fifth-hand knowledge. So we're actually the ones doing the research. We're reading the documents. We're in there peppering people with questions. We're asking the hard questions. That's what we do. So when it comes to alternatives, a lot of people think of alternatives, say, oh, aren't alternatives risky? Well, I don't know. Is investing in real estate risky? If you invested in your neighbor's house and rented it out, is that risky? Well, not if you understand real estate. I guess if you didn't know what you're doing, it might be. But alternative investments are not risky or less, they're not more or less risky than the stock market. They're just different. So, when people say, yeah, but I don't understand, people call them alternatives, so they must be riskier. Well, riskier than what? Lehman Brothers? Riskier than Bear Stearns? Riskier than, well, I won't say some of the names, but, WorldCom, Enron, you can get some of them. But, if you're looking at public investments versus private investors, there's risks in everything. It's not about whether they're more or less
Enron came up with
risky.
the carbon tax. So I mean, they can't be bad if Enron came up with the carbon tax. No, don't want to get you in trouble.
Yeah, it's not more or less risky. It's just different. It's just understanding what that risk is. That's the important piece, is understanding what you're investing in. So we look at alts a little differently, right? So let's say you're a real estate investor. It's what you do for a living. And you've got this 401k, you're investing in the stock market, and you hate it because you've got all this money investing in places you don't understand. And you're putting all your blood, sweat, and tears into real estate. Well, why not invest in real estate in your 401k or IRA? So we look at alternatives differently. We look at them as, is this a good or a bad investment? Does this make sense for you? If you're an expert in real estate, why are you investing in tech stocks or gold mines or, medical device companies? You should be investing in what you know, as Peter Lynch said. So we focus on those areas that our clients know well, and the clients who don't have those areas, we have some of our own that we manage. But we actually, as Tim said, we'll put together a free report here. It's the huge list of alternative investments. I think there's like 74, 75 different alternatives that you could choose from. They're not products. They're not something that's going to be sold by your broker dealer. They're just different investments that you can consider. And I'm not talking about like, hey, you should invest in this trailer park. It's, here's an asset class that you should consider that you probably never heard about from your broker. And for some examples, I'll give you. So real estate's an obvious
Some
one.
of the trailer parks, some of the trailer parks actually were very hot investments too. Like most of the mobile homes and anyways.
Mobile home parks used to actually have really good returns, but because everyone saw that, now the returns are a lot lower. The risks are really high, and the returns used to be commensurate for the risk, but now they're not. So if you look at all these different assets, for instance, private mortgages, tax liens, oil and gas leases, motion picture film credits, airspace rights, water rights, fishing rights. I mean, you name it, you could go on and on. There's just tons and tons of these alternatives that people can invest in. And it's really only limited by your imagination. So not only do we have a really deep understanding about how to manage the risk with these alts, but we also specialize with people who are investing in those inside their retirement account. So if you want to invest in, let's say, like private company stock with your IRA, we could help you do that. We understand the area. That's why Tim and I connected, because I know he's a blockchain cryptocurrency expert, and that's an area that we really didn't have that deep of an expertise. And Tim's got his own approach to things, which we also really liked. So
you guys actually were
for that, it was really
Bitcoin too. Even before we had met up, you guys had used one of the Bitcoin. I don't know if I'm allowed to say what the ticker symbols are, but you guys were in that.
We won't say that, but yeah,
yeah.
Let's just say there was a closed-end fund that invested in Bitcoin and Ethereum, which we invested in before the real big bubble popped. We got some really good returns out of that, but we did it in a risk managed way. So, that was a good approach at the time. We've invested in things like gold in the past, and that works well, but it's not an all season investment. It's something that we get in, when it's trending, and when it's not, then we look at other things. So we're really just, like I said earlier, we're tactical in our approach. We're looking at how can we make good tactical decisions at the time. And we're not looking to.
I just stress that we do have clients, as you mentioned, gold. If somebody says, "Hey, I have to have 5% gold come hell or high water," then we can customize portfolios where they have that 5% gold no matter what. And so we have our own thoughts on it, but we can then custom it to whatever you want. So some clients don't have any Bitcoin. Some clients already have it Bitcoin and crypto on the side, so they don't need any more with us. And then some want to just do it more tax efficiently. But I just wanted to distinguish that point, because especially if this is going out to a lot of hardcore libertarians, they might say scoff at that and say, hey, I have to have at least this. And so we can customize their own portfolios around that, and also give them advice too on what we think that we're doing is a good idea or not. Because a lot of these other companies are just facilitators, so they can help get you into this and give you all the noose to hang yourself with, so to speak. But they're not actually allowed to tell you what to do and what you should be doing or shouldn't be doing. And just because you can do it doesn't mean it's something that you should be doing. And sorry, I just wanted to make that point.
Yeah, and it's we're also to mention the point that we are fiduciaries, so we're dotting all the I's and crossing all the T's. For us, the details are very important. I know and if you're not familiar with the difference between brokers and advisors, there's a huge difference. If you look at, because I used to work at a few of the wirehouse brokerage firms, and for them it's all about selling product. That's kind of the nature of that part of the business. Whereas Tim and I are advisors, we're fiduciaries. So for us, what's really important is focusing on the client. So we have customized portfolios, which we customize for everybody. So we don't have this big vat that we dump all our clients in, like some of the other big broker dealers or what have you. We look at everybody as.
Have you heard Michael Kitces's explanation of fiduciary versus broker? So Michael Kitces is probably he's like sort of like the financial advisor to financial advisors. Like he's just one of the top guys besides probably Jeff Rose in the space, but kind of a little bit different areas than Jeff. But anyways, his deal is, he says that being a fiduciary means you go into a suit store and the suit looks good on you, and being a broker is you go into a suit store and you say, yeah, the suit fits you. And so there's a big difference between something fitting you and looking good on you. And so with the fiduciary, it's the looking good on you, versus with not fiduciary, it's hey, yeah, well, yeah, it works, yeah, you can do that, but is it the best thing? Does it look good? Does it make sense for what you're trying to do?
Yeah, no, we had, I think even before he came out with that, there was another firm, Hightower, I think came out with the difference, and there's actually a good whiteboard video on this, with the difference between an advisor and a broker. Whereas a broker, you go into the butcher, and the broker will say, oh yeah, you need to buy some meat, because that's what they're selling, right? They don't sell, well, you should go get some lettuce, and you should get some carrots, and you should get some greens in your diet, because that's not what they sell. They sell meat. So they're going to tell you, oh, you just need plenty of meat. That'll be what your health is. Versus an advisor, which is more aligned with a nutritionist. Like, oh, you need some meat. You also need some vegetables. You need these things. You need to, get plenty of water. So that's really where the advisor comes in. Is we're more of the nutritionist. We're looking at your portfolio and your life holistically, and really, anybody can manage your money. We make your life better. So that's kind of how we look at approach with our clients.
I really think it'd help if I didn't mute myself, but no, I really think that could probably be a good place to end it from here, because there's so many more things we could talk about. So maybe on a future, I'll just tease some future things we could talk about. Maybe economic opportunity zones that we're getting in with people. We have clients that invest in physical gold inside their IRAs, and Kirk, maybe on a future episode, can kind of get into the benefits of physical gold, maybe talk about the ETFs and if they really have the gold or not. Just some things I think for future episodes I know people would like to hear. We kind of teased you with the inflation stuff. I know Kirk used to have an inflation monitor that he was sending out, but again, that's not our biggest concern going on right now. But it is the weekend. I've got some family stuff I've got to get running to. Kirk has got some family stuff he's got to get running to. I've actually never seen him do a video podcast before, so I don't know if this is the first one he's done, but definitely feel honored for helping almost kind of break the video podcast cherry. But he is a prolific podcaster himself. The Money Tree podcast, very popular on iTunes. Definitely want to check him out there. And he's got tons of big name people that are on there. So maybe do you want to maybe tease the audience with some of the people you've had on there? I know I've gotten, we've had, you've had Doug Casey on, and just if you want to go down the line, just some of the bigger names you've had on there recently.
Sure. And actually, this is not my first YouTube video. I've been on a few, but nothing as notable as this. Okay. So But no, so I'm the host of Money Tree Investing Podcast. We have a weekly podcast. It's about personal finance and investing. Our format is we have a guest every week, and then we have a panel, Tim, of which is a typical panelist that we bring on. And we talk about the topics that are at hand, and there are a wide range of variety in personal finance and in investing. So as Tim said, we got on Doug Casey. We just got on we had Danielle DiMartino Booth recently. She was a former Fed insider. That was a great interview that we were able to get. We've also gotten. I'm trying to think. I don't have my list in front
It's
of me,
hard
but
to
there's
put me right on the spot, but I know that who's the guy from like Raging Bull, put in the options guy. I think he was on. I mean, there's just so many down the line. I mean, the annuity man. So I mean, depending on whatever there's like an expert financial need in. Kirk has had that person on. You've had people on about economic opportunity zones who are leaders in that. People who are leaders in. I mean, pretty much you think of the niche financial area, and whether it's I'm sure he's probably had people who are experts on student loans. I think you guys have had even crypto people on. Haven't had me on yet for that, but we've had just down the line, this a star-studded lineup of guests, and so I'd highly recommend you guys check that out. But we will be back with more Kirk at a later date, especially as things start deteriorating here, because not very many financial advisors can have a smile on their face a week after this devastating week, or want to be doing videos. But when you got your clients who are pretty much even, or maybe just down a tiny bit, or maybe up a tiny bit year to date, it really is a great thing. Because also a lot of our clients have gold that's outside of our holdings, and so if you take a look at their entire, it's not just about the money they have with us, it's about their entire picture. And so with gold being, I don't know, it's up like almost like, I think like 20 something % year to date. So so our clients have been doing well. Most people can't say that. And so if you want advisors who have insight into how we can probably give you more upside than what you're doing now, and definitely give you a whole lot, depending on exactly what you're doing. I mean, if you're just all in cash, then that won't work out. But if you're in your typical 60-40 portfolio, you've got way more upside, way less downside, sort of the holy grail of what you want to do, because we want to protect you against a sequence of return risk. We want to make your lives better. But thank you for being on the show today, and we'll give people out the best way to get a hold of you. I know you're pretty prolific on LinkedIn, so is that probably the best way, or anything else you want to get out?
Yeah, I think the best way to reach me is so you can find me at innovativewealth.com. That's our company website. We have a lot of free resources there. So if you're a do-it-yourselfer, that's a great place to learn more about just the type of investing we're talking about. If you want to contact me, you can find my information there. I'm pretty easy to contact. Just like Tim, I'm all over social media. I'm on the Money Tree podcast every single week. You can find me there. Really, I'm pretty easy to find. If you just kind of Google me, then it'll pop up. So, but I'll make sure that I give Tim the link for our big list of alternative investments for the show. And I'd love to come back on, Tim. This has been a lot of fun, and I think just to leave the listeners with, after a week like this week, if you're feeling like you can't sleep at night because you're worried about the market, the feeling you want to have is that you didn't even notice that this week happened, and that you can kind of brush it off and just say, I'm fine. That's the way you want to feel in times like this. So that's what our strategy delivers, is that feeling of comfort and financial peace, so you don't have to worry about what the market's doing. You can kind of go about the rest of your life and enjoy it.
Awesome. No, well, definitely appreciate. It's been a pleasure working with you. We're still obviously working together, and so this is the other one of the other guys I work with, and it's just crazy that we've known each other for so long, and it's actually the first actual interview that we've done together. So I know people were wondering, because I don't even tout the fact. I didn't even mention that Kirk is, according to Investopedia, is their 7th most influential advisor according to their metrics. So I mean, that's something I don't even tout. And so I mean, when you're working with me, you're also working with Kirk. And then the other guy that works with us too, Rajiv, is probably the top self-directed IRA guru there probably is. I mean, he's the guru of the gurus. And so you've got 3 star-studded people at one firm. What more could you ask for? But anyways, definitely appreciate Kirk being here. Hopefully, I know next week, I would say hopefully next week is better than last week. But for me, I actually hope the market goes down quite a bit, so that way we can pick off some of those better values if everything plummets. So for me, I'm sleeping fine at night. I know my clients are sleeping well at night. I think Kirk is sleeping well at night, and we want you to sleep well at night too. So this is Tim Picciott, Liberty Advisor, signing off. And until next time, take care.